Business confidence lifted slightly in September and is now sitting comfortably above the long-run average. But the September NAB Business Survey also showed that business conditions remain flat, with gains in profitability and trading conditions being offset by weaker employment figures and a decline in forward orders. For more on this, I'm joined by Sally Auld, the Chief Economist at National Australia Bank. Sally, thanks for your time. Look, let's start with the good news. Confidence and profitability are up. I mean, how confident is the private sector starting to feel right now?
Yeah, good morning, Ed. Well, I think what the survey really tells us is that confidence continues to improve, and as you said in your introduction, now sitting above long-run averages. So that was up 3 points in the month, and so we should, I think, take that as good news that generally business is feeling more confident, more comfortable about the economic outlook in Australia. And while business conditions were unchanged in the month, we did see that profitability index rise again, and I think that's really important because for a long period, that index was coming down, and it was consistent with lots of the anecdotes we were hearing from our business customers that their margins were under pressure. And as we moved through the middle of the year, and as the environment has got better, that profitability index has lifted now 11 points from its low. And so that's a really positive story, I think, underpinning better business confidence, and then also probably underpinning a pretty good story for labour demand going forward too.
Yeah, what industries are doing well at the moment?
Generally speaking, when we look at just levels, it's really been the services industries that are outperforming, I guess. But in the last month, what we really noticed was actually the goods industry starting to pick up a little bit more and services coming off a little bit. So maybe in September, we're starting to see, I guess, just a little bit of normalisation with services coming off a little bit, goods doing a little bit better, and then, on average, I think getting a slightly more balanced economy. But generally speaking, the thematic over the last 6 months has really been all about outperformances of the services sector. And that's personal and what we would call recreation services, but also importantly, sort of business and property services too.
All right, a little bit of bad news though. Business conditions are flat. Forward orders, which are a pretty key measure of economic activity, they're in negative territory. Just explain the significance of that forward orders figure.
Yeah, that's an interesting one and a little bit disappointing because forward orders did feel like in the last couple of months it had started to lift and generally track a bit higher. So disappointing that it fell 3 index points in the month. But generally speaking, I think we're still happy with the idea that the trend in that series is up. And this is really, I guess, one of the more important parts of the survey in the sense that it does really give us a sense of what's potentially happening in the future. It correlates really nicely with broad measures of capacity in the labour market, also employment growth. And so we do keep a really keen eye on forward orders. But I think generally speaking, because other parts of the survey are looking good, so trading conditions, profitability, and also capacity utilisation, I think we're prepared to maybe give this one the benefit of the doubt. And hopefully when we see the results for October, we will see that upward trend in forward orders resume.
Yeah, capacity utilisation now at its highest level since May 2024, I believe. What's that telling us?
Yeah, so what that's really telling us is just that there's not really a lot of spare capacity left in the economy. And this is something I think that, the Reserve Bank alluded to in the minutes from its September meeting that it released earlier this morning. Just generally speaking that effectively, there isn't much spare capacity in the economy. The labour market is possibly still quite tight. Capacity utilisation is very elevated. And so what that means is that the Reserve Bank's got to be really careful in terms of how it gauges basically where that relativity between supply and demand sits in the economy. And I think what we're learning is that really there's just not that much spare capacity in the economy or in capacity utilisation or reflected in labour markets. And so what it means is that we can get the economy back to trend growth. That's an okay outcome. But we really can't tolerate growth being much above trend just simply because in a capacity-constrained economy, if we go there, that starts to put upward pressure on the price of labour, so wages, and then usually followed by broader price pressures in the form of higher inflation rates. And so I think what we will see going forward is the Reserve Bank paying pretty close attention to these measures of utilisation in product and labour markets to guide their sense of how close the economy might be to its potential.
There's also a consumer confidence survey out today showing it's fallen to its lowest level in 12 months. It seems like consumers are worried the RBA may not cut rates next month. What's your expectation there?
Yeah, that's right. So our sense is that the Reserve Bank is likely to be on hold for the rest of this year and into early 2026. And the reason for that simply is they are, and I think we saw in the minutes today, a little bit more concerned about some of the signals they got from the last set of monthly inflation data, which tell them that services inflation has lifted by more than they expected, and also that housing inflation is starting to accelerate probably by a bit more than they anticipated. And the combination of those two things probably is forcing them to rethink the near-term outlook for core inflation. And probably, I think we'll see in early November in their forecast that actually core inflation is now sort of stuck towards the upper end of the 2 to 3% target band. And so for the Reserve Bank, I think that's just going to put the pause on rate cuts for the time being. The good thing is, with the economy travelling pretty nicely at the moment, labour market broadly at full employment, they do have time on their side. And we think it's probably going to take a good 6 to 9 months for them to get confident and comfortable about the dynamics around the inflation story before they're prepared to entertain the possibility of rate cuts. So we do think that households are going to have to be a bit more patient. And we do forecast another rate cut, but that probably won't happen until the second quarter of 2026.
Sally Auld, Chief Economist at NAB. Thanks for your time.
Thanks very much, Ed.